And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday. It is also the last day of the week because tomorrow is Good Friday, federal holiday, so markets are closed. But we will have economic data out tomorrow. It's interesting. Usually what happens is that if you have a federal holiday and economic data falls on that Friday or that Monday, it gets moved to the day before. And this is what we saw with the employment report last time it fell on a holiday, but not this year. Or not this holiday. So Good Friday, though, economic data will still come out. And, and I was talking with Michael Leibowitz, who's joining me this morning yesterday about this as well. And he actually made a good point. He says we should release all the economic data on Saturday. And that way it gives markets time to digest. And we don't have these big knee-jerk reactions to employment data or GDP data or whatever it is. Kind of gives people a little bit of time to, think about it and go through the data points and really see if it's that big of a deal or not. But nonetheless, markets will be closed tomorrow, and we will get the big vaunted the employment report for the month of March, right? All eyes are on this because, of course, ADP came out earlier this week, 145,000 jobs. That was weaker than expected. So now immediately everybody's assuming that the Friday's employment report will be weaker than expected, and it could be. However, over the last 12 months, in particular, the BLS report has not really been very correlated to ADP. In fact, it's been much stronger than the ADP reports over the course of the last year. So who knows what's going to happen on Friday? We'll see. We'll get the numbers. We'll go from there. But today is jobless claims, and we'll see if there's a pickup in jobless claims. We keep talking about all these job layoffs, right? Mostly through the tech industry, but we have seen layoffs actually spread through the rest of the economy as well, through other sectors, manufacturing, construction, et cetera. Not surprising, right? Home sales are slowing down, construction is slowing down. So you're starting to see layoffs in those areas. But it's interesting because those layoffs have not really shown up in the jobless claims. Now, very importantly, we have to talk about jobless claims for a sec. What are jobless claims? A jobless claim is when you get terminated or laid off from your job non-voluntarily. So if you quit your job, right, you're like, take this job and shove it. That's fine, but you can't go make a jobless claim, right, because you voluntarily quit. However, if you involuntarily are separated from your job, you can file for a jobless claim. And then we have two different measures of that. We have what's called the initial claim. So this is the measure of the people that are filing for the first time. That's what we get every Thursday. How many people last week filed for a jobless claim for the first time? These are people that just lost their job. And then we also have continuing claims, which are people that have continually claimed over a period of time, right? We don't pay much attention to the continuing claims numbers, but we should, because that tells us really how long it's taking people to go get reemployed, right? So if that number is rising, that means that people are having trouble getting reemployed, and that number has been rising. So people are getting laid off, but they're not getting new jobs right away. But the jobless claims numbers have been very low, sub 200,000 now for a while. And that's a very, very low level of weekly jobless claims. I mean, so think about all the things that happen in the economy, right? You have businesses that just don't make it, right? 80% of small businesses don't make it. So, there's people getting let go of businesses that are just failing from normal attrition reasons, right? Lack of capitalization, bad business planning, whatever happens. That has nothing to do with the recession. It's just a function that every week businesses are going out of business. It just happens, right? I mean, every week on a street corner, there's some rug company going out of business, right? You see the big signs. Everything must go. They've been there going out of business for like 10 years, but every week they're out there going out of business. But that happens all the time. So there's those reasons. And then there's obviously reasons where people are being cut from jobs for lack of performance, not showing up, whatever it is, they're getting terminated. So there's always a reason why, that has nothing to do with a recession. There's always reasons why people are getting terminated from jobs. And when you're talking about 190 million people in America that have jobs, right? 200,000 a week. isn't that big of a number on a percentage basis, right? So that's just kind of the normal process. What we're looking for, though, is for that number to rise. And if that number is rising fairly sharply, well, that tells us there might be something going on in the economy. Companies are really starting to cut back. Well, we've been talking about this potential recession, right? Inverted yield curves. And this is a conversation that Mike and I have a little bit more in depth today about this dichotomy we have going in the economy and the markets right now. I mean, so many indicators say a recession's coming, but analysts are optimistic we're going to avoid a recession. And yet we haven't seen, one of the data points we haven't seen, and doesn't mean we won't, but we haven't seen jobless claims really start to pick up, suggesting that companies are becoming really defensive and really starting to protect capital more than anything else. And so jobless claims continue to be relatively low. Of course, today is that number. There are some expectations that we could see a fairly sharp spike in jobless claims, that first initial kind of look that maybe the economy is starting to slow down. And we got some data points earlier this week. ISM services, still in expansionary territory, came in at 51 yesterday, but it was much weaker than the 54 estimate. So starting to see maybe a little bit of weakness now in the services sector. And remember, we touched on this a little bit yesterday, that services make up about 80% of our economy now versus 20% manufacturing. Back in the 70s, that was inverted. It used to be we were about 80% manufacturing, 20% services. So we're very dependent on the services side of the ledger right now. And think about all the things you do every day that are service-based, right? Uber, Lyft, Grubhub, DoorDash, whatever it is that you're doing. All those are the service side of the economy. That continues to be in expansion mode. It's not in recession yet, but it's coming down that way. And a lot of the subcomponents of that ISM Services Index, from employment to prices paid, et cetera, all showing fairly decent signs of weakness. Again, this is another one of those data points that have continued to weaken, suggests the economy is really slowing down, yet analysts and economists are still predicting an acceleration in economic growth through the end of the year, and more importantly, going into 2024, a fairly big pickup in growth, along with earnings rising back to where they were back in January 2020. So on one side of the ledger, and this is a conversation we'll have with Mike this morning, on one side of the ledger, we've got a Wall Street very optimistic about the markets and where we're going. And again, we've talked about for the last few days that the market's doing very well here, nothing going wrong. We had a little bit of a pullback this week as we expected, something we noted in our newsletter last week. So markets acting very bullishly right now, yet the economic data certainly tells a very different story. The question is ultimately who's going to be right and what's already been priced into the market. That's the big challenge that we have for investors. A couple of things to look at real quick before we go. Gold price has obviously been moving up here lately. Lots of concerns about things happening around the world. Gold is extremely overbought here. Last time we were this overbought, you had a fairly decent correction in gold prices. So something you may want to look at, taking a little bit of profit in that sector. Oil prices, of course, got a bump earlier this week because of the surprise OPEC cut. Oil prices also not cooperating with me this morning. Oil prices also extremely overbought here, and so that suggests that we're likely going to start to see a little bit of weakness. Even though we have this oil price production cut, likely going to see some weakness in oil prices just because simply prices kind of got way ahead of themselves. That's just generally how it works. So again, we've kind of got this shift in the markets going on right now. Weakness in the technology side of the sector. We've seen a rotation the last few days into more conservative defensive areas, utilities, staples, etc. So again, kind of expected. We'll talk more about this after the break with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What's new with Social Security this year? Our next Lunch and Learn will reveal 7 things to watch in 2023. Thursday, April 13th at noon, Richard Rosso and Danny Ratliff will share Social Security claiming strategies, the 2023 COLA, and earnings tests. Our What's New with Social Security this year Lunch and Learn with Ratliff and Rosso, April 13th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Headline in the Wall Street Journal today, Chipotle peppered with complaints over salsa spiciness. Obviously, these are not people that live in Texas. Because if you go to Chipotle, that stuff ain't spicy. That's like Bud Light, right? Just watered down. I love all the backlash Bud Light's been getting over their recent endeavors into marketing. In fact, somebody made a whole, Bud Light, we salute you, ad spinoff on the marketing genius behind their whole recent debacle. So quite interesting. But again, Chipotle, obviously, this is what you get when you get New Yorkers tasting spicy stuff.
Well, as I say, there's no such thing as bad ink.
Correct.
But
anyway, all right. Like I said, a couple of things to get into this morning. The economic data has been very interesting as of late because, first of all, if you take a look at the CitiGroup Economic Surprise Index, that's been rising as of late. What does that mean? What that means is that the economic data was coming in stronger than analyst expectations. So, in other words, you were looking for an employment number of 220,000 jobs, and it came in at 330,000 jobs. And the series of data is all coming in better than expected. And that's not surprising because everybody was very doom and gloom last year about the economy. We were going to have a recession. The yield curve's inverted. And we told you then that the inversion of the yield curve is not the warning sign. It's when it uninverts that tells you that you're moving into a recession. And so everybody was very negative on the economy and where we were headed at that time. And so expectations were playing catch up basically with the employment data, with the economic data. So the economic data was weakening, and optimistic analysts were being disappointed by the weakness of that data. And then, of course, they got very, very bearish last year. And, of course, now they were expecting very weak numbers, and the numbers were coming in better than expected. It's just kind of the way the cycle works. It's always about psychology versus reality. And what's happening now, of course, over the last couple of weeks is that the economic data, everybody got kind of very bulled up on the economy. Now the economic data is coming in weaker than what they expected. So now that surprise index is starting to decline once again. So again, not surprising. It's just psychology. Markets were doing well since October. Prices were rising. People were feeling better about things. And so it says the economy must be good because the economy is doing well. Expectations got a little bit advanced. But this does bring up the very interesting point that where we are today in the markets, right? So we've got this kind of dichotomy going on between economic data points inverted yield curves, leading economic indicators, et cetera. And of course, plenty of media commentary, YouTube commentary, you name it, talking about the demise of the dollar, the world's coming to an end, and all this other stuff. And yet the market's continuing to do very well. So somebody's right, somebody's wrong. And the question is who is it going to be? And as I said earlier, if you take a look at economic GDP forecast by mainstream economists, they're expecting only a very light slowdown in economic activity this quarter and next quarter. And by the end of this year and moving into 2024, we have fairly strong rates of economic growth coming, according to their estimates. S&P Global, who does the GAAP earnings estimates for S&P 500, also expects earnings to trough this quarter, and earnings will begin to improve into 2024. In fact, earnings, according to S&P right now, earnings will be back to where they were in January of 2020 by the end of next year. And so in order for earnings to get there, you've got to have fairly strong economic growth to support, because that's where earnings come from, right? Earnings just don't magically appear. They come from economic activity. So those two things, very optimistic. Markets, fairly optimistic. You can make a whole lot of data arguments right now, fundamentally, about potential for recession from all the economic data that's coming in. So the question is, who's right, who's wrong? Mike, welcome to the show this morning. How are you?
I'm doing great. How about you?
Good. So, this is the big challenge for investors right now, which is trying to figure out, plenty of views about an economy and a recession, et cetera. And a lot of analysts disagree, and the markets tend to disagree right now. So who's going to be right?
You know what, Lance, I wish our listeners could be a fly in the wall in our daily investment committee meetings and just our conversations that we have throughout the days. And it's every day one of us makes a bullish statement, the other counters with a bear statement, and then we both go, yeah, that's true. And there's so many pieces of diverging data. There's so much diverging data that we're getting. And some of it is bullish, some of it is bearish. On the market side, both earnings expectations and more technical readings tend to have been very bullish. And we're starting to see things that have never happened in a bear market. At the same time, we can talk to all these yield curve inversions, leading economic indicators, a whole host of data that has always told us that a recession is coming. Like ISM is now at a level that has accompanied about 80% of all recessions. ISM is services, which is roughly 2/3 to 3/4 of the economy, slipped rapidly yesterday. Again, when that thing goes below 50, which could happen any month now, that's another recessionary sign. But, like Lance started with, unemployment has yet to really show any trouble. Although in the JOLTS and ADP data, we did see a little bit of weakness. Now, a lot of that weakness in ADP hasn't carried through to the number we're going to get on Friday from the BLS. So, again, like Lance mentioned, I think keep an eye on jobless claims. That's likely where it's going to show up first. As we put in our commentary yesterday or this morning, keep an eye on things like hours worked on temporary hours. That's usually where you see the first signs that there are problems. Instead, companies don't lay off people. What they tend to do is cut their hours. They cut temp workers because laying off workers can be expensive. They have to pay jobless claims, and then they ultimately have to rehire them. And you also don't want to upset your workforce that is still working for you. You don't want them trying to find new jobs because they're scared for their jobs. So there are other little things that we'll look for, but have yet to really show any signs that employment is slipping. But we actually wrote an article. Janet Yellen should have hope, something about hope. And what HOPE is an acronym for is the progression through which the economy heads towards a recession. It usually starts with housing, goes to new orders. New orders are found in the manufacturing and services indexes like the ISM. And then it goes to profits, corporate profits, and it goes to employment. So the H and the O have certainly showed signs of recessions. Profits have weakened, but they're not really declining rapidly. And like we said, employment has yet to really show much trouble at all. So it's progressing, but there's certainly bullish and bearish cases, and I'm sure Lance and I are going to be countering and making points and counterpoints for the next months of meetings, and that's going to, create a need for us to be more active, more vigilant, have stop losses in place, but also take riskier positions at times as well.
Yeah, and again, that's the challenging part here because, even when you take a look at this rally so far this year, one of the keys for a bull market is you need a bull market that's fairly broad, right? So you have a lot of stocks that are participating in that rally. And that's not been the case this year. 88% of the rally since the beginning of the year has been, defined by roughly 10 stocks. The last time that we were writing articles about that narrowness was in late 2021, about October of 2021. We saw exactly the same thing. We had 10 stocks making up 80-90% of the advance. And of course, it was just a few months later that all kind of ended as we got into 2022. So it doesn't mean that necessarily, it's a horrible thing that you have just a few stocks driving the markets, but it does go to suggest that the market is not as strong as it appears on the surface. Part of this has to do with the passive indexing issue that we've talked about before, which is you have so many ETFs that own the same stocks, right? So Apple's in like 400 different ETFs. So every time somebody buys an ETF, money's just flowing into Apple, into that stock price. And they get roughly those 10 stocks, you're getting 30-40% of the flows that are coming into the market. So you get this bifurcation in the market that's not necessarily, as healthy as it just looks like on the surface, right? The market's doing great. Everything's up. Well, not really, because if you look below the surface, there's a lot of stocks not participating in this rally. In fact, it's been kind of an interesting point that last year, everybody loved energy and hated tech stocks. This year, energy is the worst performing sector and technology is the best sector. So you've had this rotation in the markets, but again, the market action isn't broad. You're not seeing a lot of participation across the overall market. Financials, obviously, under a lot of pressures of late because of Silicon Valley Bank and Credit Suisse, et cetera. That's one of the largest sectors in the S&P. So if that sector was participating, the market would even be doing better, right? But it's not been participating. It's been a lot of technology. Now, the last couple of days, and we talked about this in last weekend's newsletter as well, we said, hey, look, every sector of the market is overbought. We had a chart in our newsletter showing the overbought, oversold conditions and of every major sector and major market. They were all pegged at the top of overbought. We said, hey, that's likely going to get a sell-off this week. We're likely going to get some kind of relaxation in the markets because everything's so overbought. You've got to have a little bit of a pullback here. And we also noted that the most out-of-favor sectors, which have been lately utilities and real estate and healthcare, would likely get some relative performance. This is a lot of work that Mike does on a regular basis, and that's exactly what's happened this week. So we've had a very normal rotation this week and this bit of a pullback. But again, as we start to look forward, where's the market heading to next? And do these recessionary indicators tell us any clues as to what that might be? Be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What's new with Social Security this year? Our next Lunch and Learn will reveal 7 things to watch in 2023. Thursday, April 13th at noon. Richard Rosso and Danny Ratliff will share Social Security claiming strategies, the 2023 COLA, and earnings tests. Our What's New with Social Security this year Lunch and Learn with Ratliff and Rosso, April 13th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Kids are awesome between the ages of 0 and 10. You get to play with them, Legos, you name it. 10, 11, somewhere in there to about 19, they are a pain in the ass. They know everything.
The Real Investment Show podcast. Same show, your schedule.
Every time I say something to my daughter, I know. She knows everything.
At realinvestmentadvice.com.
If you want to know anything, ask my daughter because she will know the answer.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So that spot you played about my daughter knowing everything?
Yes.
So I thought I was going to have fun with it yesterday, and she came in. She says, "There's something wrong with my car. It's making a funny noise." I said, "Well, did you check the defibrillator?" She goes, "Of course." I go, "Well, if it's not the defibrillator, you may want to try the combobulator because it's under the hood to the left of the battery, and if you fix that, generally it takes all the noises out of the car." And she's like, "I know." So I'm waiting to see how long this takes her to figure it out.
Yeah. Ask her to check the blinker fluid level.
Oh, that's definitely coming today. So I know.
It's right next to the flux capacitor.
Everything. Yeah, exactly. The flux capacitor. See, the only reason I didn't use that one is because she knows the movie.
Oh,
right. So that's one of her favorite movies is Back to the Future. So if I used anything relative to that,
that'll be the last one you use, and you'll see the light bulb go off. Like maybe he's been messing with me.
Maybe just a tad. Anyway, so. All right, so again, the markets, again, doing just fine. We talked about the fact that the markets had broken above important resistance lately, had gotten through the moving averages. Markets on a buy signal right now. The MACD buy signal is in place. Our money flow indicator that is kind of our proprietary indicator that we use to manage portfolios is also positive. So there's, the market's acting bullishly despite the fact that, again, we have all this data out there, whether it's leading economic indicators or our economic composite index, which comprises 100 different data points from services to manufacturing to leading indicators, et cetera, has never been wrong relative to predicting a recession, currently predicting a recession. Same thing for the 6-month rate of change and leading economic indicators, which is also an infallible recessionary indicator historically. Could this time be different? Maybe. But that's the challenge. And here's the interesting point about this, and I'm going to get Mike fired up over this because he just did a whole piece on this. But this is according to DataTrek. This is the quote from DataTrek. This is how equities on average trade in the last 4 end of hike periods. So this is saying that when the Fed stops hiking rates, how do equities trade following the end of that last rate hike? So if the Fed is going to stop hiking rates at this next meeting, and there's about a 50-50 chance right now of no rate hike versus a 25 basis point rate hike, this is how they trade. So I continue the quote. 1 month later, equities are up 3.3%. 3 months later, they're up 8%. 1 year later, up 17.5%. Conclusion, U.S. equities tend to rally in the month, 3 months, and year after the Fed stops raising near-term rates. The only exception was in the year after the Fed's last rate hike increase in March 15th of 2000, which was preceding the bursting of the dot-com bubble. So, and this is kind of the interesting dichotomy, right? Normally, stocks tend to rally during Fed rate hiking periods, yet we had a 20% decline during that period. Now the Fed is potentially at the end of the rate hike cycle, and this has been one thing that markets have been rallying on, is this whole hope of a pivot or a stop by the Fed of raising interest rates, and that means equities tend to perform better. This is another big challenge here. Is that really the case? Mike, you just did some research on this. What did your details tell you?
Well, that helps explain a lot of the confusion in the markets. So the report and research I did talked about from the day the Fed started cutting rates that year out, and it also looked at when the Fed was raising rates, but it didn't look at that plateau. So if you go back and look at all the Fed fund cycles, what typically happens is the Fed raises rates, then they stop for a period of time, and they flatline. It's kind of like a mesa, and then they start cutting rates. Sometimes that mesa is only a few months. Other times that flatness is a year or longer. And sometimes they just pause and then rates go higher, or they pause and rates can go lower. So what my studies show is that once the Fed starts cutting rates, the average drawdown is about 27%. Recent drawdowns have been much worse, but that's because valuations have been higher than normal. And this has been true. That covers the last 9 Fed rate cuts, 9 recessions, essentially. So what you just quoted, Lance, is that period of time is when the Fed's kind of doing nothing, right?
Right.
So right now, the Fed is telling us they may do one more, and then they're going to leave rates alone for a year or for the rest of the year. So they're, I guess, sending you a bullish signal, right? Because based on your data, the market does well when the Fed's raised rates, but then does nothing. It's as if the economy's fine now. We've done our job. We've achieved a soft landing. Unfortunately, those plateaus never stick around, and the rate cycle is called a cycle for a reason. It's because it oscillates up and down. So the question that we all have to answer, and the thing we debate all the time, is how long is that period where the Fed does nothing? And, the problem is that period hasn't necessarily started yet, because the Fed still talks as if they may do one more. The market is still pricing one more. But what's interesting is, if you look at the market, Lance, I'd say that analysis that you just gave us is what's bullish. Mm-hmm. But at the same time, if again, another divergence. But if you look at what the markets are pricing in the Fed funds, bond markets, they're pricing in a pretty aggressive rate cut starting as early as June or July. So it's, again, there's so many points of diverging data that send different signals. And in a lot of these cases, both signals have proven to be historically really strong. So the key, I think, is for us to understand what the market thinks, what the Fed thinks, what's probable, and how those big differences at times between opinions resolve themselves, because they will resolve themselves. It's just a question of whether the Fed acquiesces and drops rates significantly, or if the Fed is right and we're going to be stuck at roughly 5% Fed funds for the next year, and the market's going to have to adjust to that type of level.
Well, and again, this is why, two things. I think there's two important takeaways from this for investors, and this is the thing that I think gets more people in trouble than anything else, which is you take this headline out of context, and everything Mike said is absolutely correct, right? And this is historically how it always works. Now, could this time be different? Yeah, there is a little bit of a difference this time. Only in the standpoint that normally during rate hiking cycles, the market's still doing okay. Generally, when the Fed's starting to hike rates, they're worried about economic growth. It's too strong. And so they're hiking rates, and there's a lot of momentum in the market, right? So everything's still fine. The economy stocks are still rising during the rate hike. And then once they have to start cutting rates, it's generally in response to, they broke something. And that's historically been the case going back over history. This time, the difference this time is that stocks actually declined during the rate hiking period, which, again, that's a little bit different than what we've seen in the past, but it's not unprecedented. So this is the problem, though, with taking this data. And again, you can take the bullish view of this. Data Trek says, hey, every time the Fed starts hiking rates, stocks do well. And so you go, great, I'm bullish, I'm all in. And then something breaks, and then before you have time to respond, markets are down 20, 25%. And that's the way it historically works. But this is the problem with headlines and again, when you start looking at, and we talked a good bit about this yesterday about social media, because we were talking about how Gen Z, the majority of Gen Z are getting all their news now from TikTok. And, which is fine. There's nothing wrong with that. Well, there is, but the problem is you get in a silo, so you only get one side of the information. And this is, and so when you start making decision based on just one side of the information, that's that confirmation bias. We only want to hear that particular news. And again, it's very easy to kind of get sucked down these rabbit holes of everything being bearish, right? We talked, Mike and I talked last week about the whole reserve currency issue and those issues, and that's been all over the headlines as of late. Just reserve currency and de-dollarization, and people are panicking, and I'm getting emails every day about, oh my gosh, what am I going to do? Those are very big macro issues that take years, if not decades, to play out, and particularly when it comes to dollarization, that may be decades we're talking about before anything actually occurs from that. So making short-term decisions based on those type of headlines can take you down the wrong path. Also, being overly bullish and ignoring all the recessionary data is also something that will get you in trouble as well. So that's why it's so important to make sure that you're considering, and this is what Mike was saying about being audible and being flexible, because we're in one of those transition periods in the economy and the markets where the true trend of the market has not revealed itself. It could be bullish, or it could be bearish. And we're in that transition period right now where the market has yet to really declare itself in one direction or the other. We're getting some short-term bullish action, but a lot of bearish economic data. One of those things are going to be correct. Either the bearish action of the market is going to be correct. The bullish action of the market is going to be correct, and the bearish economic data will turn and catch up to the markets, or vice versa. And again, we just don't know what that is yet. But again, getting kind of sucked down that rabbit hole of being on one side of the coin or the other is what gets you into trouble. So a quick break. We'll come back. We'll finish up with Michael Leibowitz. I want to switch gears here just a little bit and talk about, something else, particularly with the Fed Reserve coming up. That next FOMC meeting is going to be pretty crucial. Talked about what we're hearing from several of the Fed speakers as of late and what that might mean for the next rate hike. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What's new with Social Security this year? Our next Lunch and Learn will reveal 7 things to watch in 2023. Thursday, April 13th at noon. Richard Rosso and Danny Ratliff will share Social Security claiming strategies, the 2023 COLA, and earnings tests. Our What's New with Social Security this year Lunch and Learn with Ratliff and Rosso, April 13th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show. This is really kind of a two-part issue as we get ready to go into the next Fed meeting, because I'm actually writing an article about this weekend. I've gotten lots of emails about the reverse repo program. And this is the reverse repurchase program that the Federal Reserve has. And it's surged now to well over $2.5 trillion inside this program. And, so kind of writing a little bit of a detail on it in this weekend's newsletter, explaining kind of what it is, why it's there, how it's working, etc. But, lots of concerns, obviously, right? Because of bank stress and the banking crisis as of late. What does this mean? And this reverse repo program is at levels we have never seen before. Even during the financial crisis, the usage of the reverse repo program was nowhere even remotely near this level. I mean, it's a massive spike in the usage of this program. So, but this has two kind of components to it leading up into the next Fed meeting. So what happens in a very basic explanation, the Federal Reserve sells securities. So I'm the Federal Reserve and Mike is a bank or a money market fund or, somebody else. And I sell him securities overnight. And the agreement is that he will sell those back to me tomorrow at a specified price that is higher than the price I sold him to today. So it's a guaranteed transaction, and that repurchase, right? The Fed is going to repurchase those securities back. When I repurchase those securities back, the differential, what Mike gets, is basically the interest rate. And what the reverse repo program does is it helps kind of control the Fed funds rate and the gives them some control over that overnight lending rate. So the problem is that, or I shouldn't say there's a problem, there's not a problem. There's just been a massive surge of this because of money now flowing into money market funds that are using the repo program because they need short-term obligations, right? Because it's money market. I've got to have cash available at any time. If Brent is using Mike's money market fund and Brent has $100,000 in Mike's fund, and Brent says, I need my $100,000, he's got to have liquidity. So money market funds need very short duration. So if you look at what they use for their assets, it's very short-term bills. It's 1 month bills, 3 month bills with very, very short durations, close to maturity. So there's lots of liquidity. So they can redeem those money market fund shares on demand. One of the concerns about all this is that money market funds are not great reciprocators to the banks. As money market funds have risen in terms of yield, right? Now, a lot of money market funds are 4.5%. Go to your bank. What do you get at your bank? 0.1 if you're at JP Morgan on your money market balances. It's sucking a lot of the capital out of the banks into money market funds. So this is putting more stress on small to mid-sized banks that don't offer money market funds. JP Morgan has money market funds, right? So they get the benefit of all this. And because of concerns over small bank viability, depositors have been moving their assets to bigger banks for security reasons. This is putting more stress on the small banks. So this is why, one of the concerns is this recent banking crisis that we saw with Silicon Valley Bank and with Credit Suisse isn't necessarily the end of the banking crisis because of what's happening with this transaction of money flows coming out of small banks. Their deposits are leaving. Their collateral is depressed in price. Loan demand has fallen sharply because of what's happening in the commercial real estate market, and the real estate market itself, the housing market. Credit card default rates are rising. So small banks have a lot of problems. And, the Fed funds rate at 4.5% or approaching 5% isn't helping them because it's sucking assets out of their banks, which is impacting their reserves. Okay, having said all that, that's a very basic explanation. There's lots of stuff that has to be filled in around that, but I think that covers most of it. Mike, this puts the Fed in kind of an interesting position in the upcoming meeting. One thing that they could do is hike the overnight rate by 25 basis points, but drop the rate that they're paying on overnight reserves to try to force some of that money out of the repo program back into the banks. So it's kind of an interesting challenge.
I would actually argue the other.
Okay.
The problem the Fed has is that they put too much money into the economy.
Yeah.
Basically, they did too much QE. And you can see by their repo balances, at least $2 trillion of reserves that are not being put to use. So when I mean not being put to use, they're not being lent. They're just sitting on banks' books, and they are ultimately going into risk-free overnight investments.
Correct.
So just to back up a second, everything Lance and I have written about the Fed setting the Fed funds rate is wrong. It's technically wrong. What the Fed does is they set the Fed funds rate target. The Fed does not control the Fed funds rate. The Fed funds rate is the rate that banks borrow from other banks. And the Fed will say, we want that rate to average 5%. And every day they put out the effective rate. And the effective rate is the weighted average of all those trades that happen during a day. And if the Fed's target rate is 5%, there's plenty of days where the effective rate is not 5. It doesn't vary by a lot, but it can be 4.90, 4.95, 5.05. And at month end and quarter ends, it can vary by quite a lot. So the Fed doesn't control the rate. They have to manage the rate. And they do that by putting money into the money markets, taking money out of the markets. And they've been doing this forever. And you can say it's QE, QT, but it lasts for a day. So the funds aren't put to use in the real economy or even into markets because they're so short-term in nature. So the Fed realized they have a problem. They put too many reserves on the banks' books. The banks weren't lending that money, and that money needed a place to go. Well, the banks are going to invest it. So there's plenty of things the banks can do with it. But everything they would do with it would push overnight rates lower. There's just too much supply, too much demand, and not enough supply of overnight investments. So the Fed makes their rate on these reverse repurchase transactions very competitive. So it basically absorbs the 2 trillion plus now, 2.2, 2.3 trillion of funds that really has no place to go. The banks don't have any desire to lend it. It's also money market funds. Fannie Mae and Freddie Mac constitute a big chunk of that money as well. Everyone's sitting on cash from QE, but it's not getting put into the real economy. And Lance, the question and the reason I kind of started with, well, maybe they'll do the opposite. They don't want that money going into the economy because it's very inflationary.
Correct.
Once they make a loan, that's printing money. And if the Fed were to say, you know what, we're only going to pay you 2%, well, what would happen? The banks and the money market funds, or the banks, let's just talk about the banks. The banks have two options. They can either accept a lower rate somewhere else in some other investment. You know, they can buy very, very short-term treasury bills, very, very short-term corporate paper, Fed funds. It would push those rates lower. It would push the Fed funds rate below where the Fed wants it to be. Or they can make a loan. And when they make a loan, that can be inflationary. They're printing money at that point. That's inflationary. So, you know, has become, as the Fed gets more and more, as they grow in their governance of the markets and the way they control the markets, they need bigger and bigger tools to manage the markets. And that's what this has become. It's a, $2 trillion overnight facility to help take the funds out that they put in with QE.
Right. And the problem though is, and again, there's another problem. So they say, okay, let's do what you said and let's lower the lending rate to 2% and force that money back into the banks. Well, the banks have a problem because, well, do you really want to make commercial real estate loans right now? You want to make mortgage loans at the moment? Right. You want to make credit card loans? You want to make auto loans? I mean, all those are, the credit card delinquency rates are spiking sharply, particularly in small banks that aren't in the top 100. There's a big jump there. Most of the smaller regional banks, the majority of their loans are local. Loans are fairly local, right? So, most of your small regional banks, they're making the local commercial real estate loans, the local housing loans, those type of things, car loans, et cetera. So there's no really incentive for them to make those loans and take the risk. So it's really a dichotomy, right? They're getting paid enough to keep that money in overnight lending rates. They just had a screen up on CNBC while you were talking, showing the deposit rates at all the major banks versus Interactive Brokers. Interactive Brokers right now is paying a little over 4%. Fidelity pays over 4%. Schwab pays like 0.4%. JP Morgan pays 0.01, Wells Fargo pays 1, but everything is well below, on deposit rates. Everything for the consumer is 3 percentage points below what the Fed is paying out in overnight rates. And so banks are sitting back going, why take the risk of loaning anything, right? This is the conundrum. Why take the risk of loaning any money out? I can just collect my money here and not pay my customers anything, and I make a huge spread.
Right.
So, Mike, closing comments. You got 30 seconds. Go.
Just keep your head on a swivel and just, this economic data is starting to turn lower, but bullish signs in the market are starting to look more optimistic. So just keep an eye on everything and be ready to act in both directions.
There you go. All right, that wraps up the show for today. Get by the website. Our newsletter will be out this weekend, even though it's a holiday. It will be out for you on Saturday. Also, of course, while you're there, make sure and get our daily market commentary. We'll post that this morning at 7:30. And then, of course, we'll keep you up to date with the markets, your money, everything else right there at realinvestmentadvice.com. Have a great day. And most importantly, have a wonderful Easter holiday. And we'll see you back here next week.